Good afternoon, everybody. It is Monday and it is time for a Monday market update. I'm Jennifer Tim with the Welcome Home Global Group. And as a real estate planner, I am absolutely honored to be able to share what is going on in the market and how that is influencing real estate and potentially what that means for you and your family. So let's get right to it. So our big question for December the 11th is, have interest rates dropped? And we're talking about mortgage rates, of course. So let's get right into that national news. Well, okay, before we even talk about the interest rates, let's talk about what concerns sellers the most, and that's home prices. And even though we have an average 30-year mortgage rate that exceeded 8% this year. Thank goodness. We'll have a look and where that is. Right now, we can see that housing data providers Black Knight and CoreLogic both saw home prices increase by 0.2% month over month during this past month. And of course, that means that year to date, prices have risen 6%. So despite all the craziness that's out there, we are still seeing that homeowners are building equity in their homes every single month. And at the end of the year, we're sitting at about the 6%. Not bad news to start off today's presentation with. The job market. So much of what happens with mortgage rates really depends on what's happening with the economy as a whole. The job market data is definitely influencing what the Feds are doing and the decisions they're making regarding Fed interest rates. So on Tuesday, the JOLTS report, the Job Openings and Labor Turnover Survey, shocked the market with job openings dropping to 8.73 million in October from 9.35 million in September. So while that's still a rather large number, you need to keep a few things in mind. It was definitely below the expectation of 9.4. It is the lowest job opening figure since March of 2021 and 27% below the peak for job openings, which was 12.03 million in March of 2022. The pre-pandemic figure was 7.18 million in January of 2020. Next one, ADP's private employment report was released last Wednesday, which showed a continued slowdown in both job growth and wage growth. So companies added 103,000 jobs in November. So that means the 3-month moving average for additions was 99,000 a month, and that's the lowest figure since March of 2021. And while total job growth was still positive, several important sectors shed jobs during the month. Leisure and hospitality, manufacturing, professional and business services, and construction. So wage growth eased to 5.6% year over year, and 8.3% year over year for people who got a new job. A year ago, these figures were 7.6% and 15.7%. So wages are still growing, but they're growing at a lot slower pace. So now, why does the Fed care so much about employment? Why are they looking for a loosening of employment? So in other words, they're looking for data that shows that people are losing their jobs. So they're looking at inflation and employment levels. And without clear signs that the historically tight labor market is loosening up, the Fed will be concerned that inflation could come roaring back. So their Fed rate increases have definitely slowed the economy down, reduced the inflation rate. But as callous as it sounds, we need to see the unemployment rate rising to convince the Feds that rate cuts rather than more rate hikes are the next course of action. Pros and cons to that was listening to an economist this morning who basically is calling out the Feds and saying that their insistence of seeing this before the Feds decrease the Fed rates is basically killing the real estate market. And for any buyers out there who have been facing those interest rates that did peak over 8%, you can definitely sympathize with that point of view. So the final Fed Open Markets Committee meeting for this year will take place this week with a policy decision, rate decision on Wednesday. And no one currently expects that there will be a rate hike or a rate cut. The general consensus with economists that I follow is that the Feds are just going to wait and see what happens in December. So are we as consumers going to end up spending a bunch of money? And are we going to see people just sticking in their jobs? What is going to be happening? And we'll definitely be analyzing the results of their decision next week. So now, how has that related to active listings? So this is our national figure. It goes back all the way to July of 2016. And as you can see, while we have seen an increase in active listings, we are definitely still below those pre-pandemic levels. Nothing really to do with the pandemic per se, but there's definitely there's a reason for this. So it is hard to rationalize that. How is it possible, considering that our interest rates jumped from 3% to 8%? Why we haven't seen a major increase in we haven't seen an increase in the number of properties on the market, coming on the market, and we haven't seen those prices decreasing. And it's all about the low inventory. It's supply and demand. Our demand has remained much greater than the supply that's been on the market. And as a result, those prices have just kept going up. And because the interest rates have stayed higher, we have basically seen that the majority of sellers have said, no, hold on, I am not interested in swapping out my lower interest rate for that higher interest rate, which is the prevailing rate right now. And why would they? Why would you potentially double your mortgage payment just to put your home on the market? There has to be a really good reason. So a couple of latest updates from realtor.com's residential listings database. The active listings in November did increase 2.4% month over month to 755,000. And normally we would see inventory falling because this is the normal cycle of the holidays where sellers will not put their homes on the market because they've got family coming into town, they've decorated for the holidays, and they don't want the hassle of putting a home on the market and having, open houses and potential buyers traipsing through. They want to settle down and enjoy this time with family. 755,000 is more than double the March 2022 lows, but it is still 34% below our pre-pandemic levels of November 2019. For the first time in 18 months, new listings in November were higher than the same last year. And for the top 100 metros, 69 saw month-to-month increases in inventory, largest increases being in North Portland, Sarasota, but then also the other cities that were listed. For the top 100 metros, 45 saw year-over-year increases in inventory. So inventory is slowly rising in certain markets, and you really have to look at each market individually to see where they are. Mortgage rates. So the big news is definitely that, yay for buyers, there's the gift that hopefully will keep on giving, that rates have fallen by 1 percentage point in less than 2 months. So remember our peak, October 19th, 8.03%. Currently, and this was as of the end of last week, 7.04%. And we'll see what happens this week. The market will respond to whatever the decision is. We might see a slight increase or a decrease. we're going to have to wait and see after the Feds meet this week and we hear the announcement about the Fed rate on Wednesday. So keep in mind, a year ago, we were sitting at 6.29%. We're just higher than that, unfortunately. And our previous low was February, the beginning of the year when we were at 5.99%. But we are celebrating that the interest rates have come down into the sevens from the eights. It doesn't sound like a lot, but it truly makes a big difference to home buyers and that affordability. So what we are starting to hear is that we're going to potentially see between 1 and 6 rate cuts over the course of 2024. And in our market update coming up, probably the week before Christmas, we will do a big where are we going, what's happening, what are the predictions for 2024, and we'll share various sources. But this is good news for our buyers, and we're starting to see that reflected in mortgage applications. We're definitely seeing a renewed interest from buyers, even though sellers are still not willing to put their homes on the market. We are seeing more and more buyers, which, unless those properties start coming onto the market, will result in home sale prices going higher and higher. So, and this just basically sums it up from Dr. Selma Hipp, CoreLogic Chief Economist. Home price growth maintained its upward momentum in October, which continues to reflect gains from the strong spring season and contrast with last year's home price declines. But even with high mortgage rates, October's price gains line up with historic trends and speak to the strength of some potential buyers' purchasing power as they continue to outnumber available homes for sale. Metros that are seeing relatively stronger price gains are those with higher job growth, as well as of those with an influx of higher income in migrating households. So it is good news for the real estate market. We are hoping that when the Feds drop those interest rates even more, this is a gift that will keep giving to both our sellers and buyers, because then sellers will be more inclined to put their homes on the market when they have to consider swapping out their current low interest rate for a slightly higher one, rather than a potentially double what they're paying. What's happening in Southern California? Always like to start out with a couple of our local lenders. So this is from Wells Fargo. Clark Cornwall is one of my mortgage lenders that I work with there, and he sends these updates on a regular basis. I haven't yet received the most recent one for this week. So this is as of the 1st of December. And they specialize in jumbo loans. So what we're looking at now is interest rates sitting in the sixes. They are with discount points. Your annual percentage rate is going to be anywhere from that jumbo 30-year fixed at 6.5% up to your ARMs, which could be 7.1, but that is with purchasing points. Another option would be El Rodriguez with the Rodriguez Hazard team. And this was an update that we received more recently. And we have their jumbo loan. So they're looking at 30-year fixed at 6.75%. Their APR is 6.93. Conforming loans are 6.73 with a 25% down payment. Of course, FHA and VA loans are your best bet if you qualify for those and your purchase amount qualifies for your FHA loan. But as you can see, even though the Fed rate is sitting at just over 7%, our local lenders are already able to offer loans that are less than that, based, of course, and subject to what your position is as a borrower in today's market. So just a quick Southern California prices. This was an update from the Pasadena Star News. Home prices saw their biggest percentage gain in a year in Southern California, rising 4.3% to $735,000 in October. The higher median combined with higher mortgage rates in October to lower the number of homes sold by 8% from the prior year. Lower sales were due to both fewer homes on the market, we keep talking about inventory, and fewer buyers willing to pay higher mortgage payments. However, because interest rates have begun to fall since October, sales may pick back up again and improve throughout 2024. Again, we will go through some predictions the Monday before Christmas, and let you know what all the experts with their crystal balls are saying about what to expect in 2024. Another one, and this was the latest update from California Association of Realtors, and this is across the state. We had 477 closed sales on average per day, 381 pending sales per day. So as you can see, we're definitely still closing deals, and yet our new listings per day is 457. So as of that closed sales, you can see that we are outstripping the availability of homes. So again, this is what keeps pushing home prices and values up, because we have a supply problem. Our demand is definitely outstripping supply. Looking at some of our cities, starting off with Danapoint, our median list price for homes in Danapoint is 5.8 million. New listings coming on 3.8 million, and our average days on market is 121. Median days on market, we like to eliminate those outliers, 77. Our inventory, we've seen a slight uptick in inventory, and if those are those higher price properties, they definitely end up sitting a little longer on the market. We are still in a slight seller's market because we just don't have enough inventory for the demand that's out there, despite the fact that our median prices of our listings and our new listings coming on are definitely in that luxury band. Laguna Beach, speaking of luxury, median list price 4.7, new listings coming on 5.1 million. Median days on market 95. It's kind of, just hovering in there, and we have 114 properties on the market, so that's staying pretty even. Now, of course, the higher priced the properties, the less that mortgage rates influence what is happening, because generally at that price point, our buyers are not really in the market for a home loan. They tend to be cash deals. So this is just more of a cyclical market that's stabilizing for the holidays. Sanclemente, median list price 2.3. New properties coming on 1.9. Our median days on market 56. As you can see, with these more affordable properties, and this is that sweet spot where we're sitting of new listings, just under the 2 million, but our sweet spot is definitely below 2 million, and that's reflected in the median days of market of 56 days. Our inventory 75, slight uptick. Those tend to be our higher priced properties that are sitting there. Anything that's going to be priced well below that 2 million is probably going to sell pretty fast. Again, slight seller's market in Sanclemente. San Juan Capistrano, median list price 2.6. New listings coming on 1.465. Median days on market 35. Here again, more affordable homes, when they hit the market, they are going to sell faster. There is a bigger buyer pool. The affordability is there for more buyers, and they are willing to jump in and snap those properties off the market. So 35 days is our median days on market, and our inventory, again, it's going to decline. If we see more of these properties coming on, you'll see that inventory drop. So once again, San Juan Capistrano remains our strong sellers market in our area. So sellers, it's a good time for you. So bottom line, to get back to have interest rates dropped, yes. And as has been mentioned, we hope that this is the gift that keeps on giving, that the feds will realize that the aggressive nature that they and basically plan that they put in place to address inflation really resulted in a recession in the housing market more than anything else. There's not been a general economic recession, but in housing, we have definitely seen it. We need interest rates to keep dropping to address the housing crisis that we're seeing right now. Unless the more homes come onto the market, which means that sellers are okay with swapping out their lower interest rates that they have, we're going to have a really tough 2024, and it's going to be another year of struggling for our buyers to find affordable homes. So keep in mind that in California, 85% of homeowners with a mortgage have an interest rate that's 5% or lower. So when we're talking about sellers and their reluctance to swap out that lower interest rate, this is what we're talking about. It's affordability, because the majority of sellers will become buyers. So until this is addressed, until the feds do what's necessary with interest rate cuts, like too many hikes. I'm so used to talking about the hikes, and thank goodness we're hopefully getting to the point where we're going to be talking about some rate cuts rather than hikes. So until that happens, we will not see more sellers willing to put their homes on the market, but that's what we need. So as always, as real estate planners, we are here to help Southern California families grow, protect, and transfer generational wealth through real estate. And we can help you do that across the globe, as we are certified international property specialists. We have a number of tools to help you. We've got generational wealth building. We've got an equity analysis on your home. Capital gains tax assessment. We're hearing from a lot of our investors or even primary homeowners that they're concerned about that capital gains liability if they do sell their homes. Well, there are strategies that we can assist you with together with your financial experts to make sure that the right solutions are in place for you to reduce or potentially eliminate your capital gains tax liabilities. And of course, our favorite one, number 10, Family Feud Prevention Plan. Keep in mind that if you are building a legacy of real estate to transfer to your children, that real estate cannot be divided, and chances are none of your children, if you have multiple, are ever going to agree on what needs to happen with the real estate. So let's take a proactive approach so that your hard work can truly benefit your heirs, rather than leaving it up to them once you've passed. And then what happens? You've basically blessed the legal system, because your family members are going to end up in court. Feel free to reach out at any point in time if you've got any questions about the equity in your home, what's happening in the future. I mean, honestly, anything and everything to do with real estate. If you need a referral for a particular service, we are here to support you. And with that, enjoy this beautiful week in Southern California. It's a crazy time of the year. I know we have in our family, I think we have 5 holiday parties. This week we actually declined 3. So this seems to be the week for everything going on. We're so honored to be able to connect with people. Apologies that we can't attend everything, but our focus is assisting our clients, and the parties have to happen around that. So have a wonderful week, and we will be in touch next week.